Hello everyone and welcome. In this session, we're going to discuss a powerful tool for managerial accounting, segmented reporting. We'll learn how to get a much clearer view of profitability by breaking the company down into its component parts. This allows us to make better, more informed business decisions. Here is our agenda for today. We'll start by looking at the problem with a single company-wide income statement. We'll then introduce segmented reporting as the solution. To do this correctly, we must understand the key concepts of traceable versus common fixed costs and learn how to calculate the most important metric, the segment margin. We will then put this knowledge into action by analyzing a keep or drop decision and performing break-even analysis at the segment level. Finally, we'll cover some common mistakes to avoid in segment reporting to ensure our analysis is always sound. So, let's start with a problem. A company's overall income statement can often be deceiving. Let's look at our case study company, ProfitMax, Inc. As you can see from their variable costing income statement, they had total sales of $500,000, a total contribution margin of $270,000, and a final net operating income of $13,500. So, the company is profitable. But this brings up a key question for management. Is every single part of the business actually pulling its weight? Is it possible that there are hidden losses in one area being covered up by highly profitable areas somewhere else? A traditional company-wide income statement simply can't answer this question. The solution to this problem is to break down the business into smaller pieces. To get clear answers, we can slice the company into segments. A segment is simply any part of an organization for which we want to see separate cost and revenue data. ProfitMax, for example, can be segmented in a number of different ways. As you can see from the chart, we can segment by division, such as the business products division versus the consumer products division. We can go a level deeper and segment by product line, like computer games versus clip art. We can even segment by sales channels, such as online sales versus retail stores. Now, to segment our income statement properly, it is absolutely essential that we separate our fixed costs into two distinct types, traceable and common. First, we have a traceable fixed cost. This is a cost that exists specifically because of a particular segment. If we were to eliminate that segment, the traceable fixed cost would disappear. A great example is the salary of the Fritos product manager at PepsiCo. That salary is a traceable fixed cost to the Fritos segment. The other type is a common fixed cost. This is a cost that supports the operations of more than one segment. Crucially, a common cost would not disappear if we were to eliminate one of the segments. For example, the salary of the CEO of Hyatt Hotels is a common fixed cost to all of the various hotel divisions. With that distinction in mind, we can now calculate the single most important metric in segment reporting, the segment margin. The segment margin is calculated by taking a segment's contribution margin and subtracting its traceable fixed costs. The result tells us exactly what that segment is contributing to the company's ability to cover its common fixed costs and generate a profit. This is the best gauge of a segment's long-run profitability. As a rule, if a segment cannot cover its own traceable costs, meaning it has a negative segment margin, it should be a candidate for elimination. Let's put this into practice with a decision. The retail store's sales channel at ProfitMax has a negative segment margin of $3,000. Management is considering dropping this channel, and they believe that if they do, online sales for computer games will increase by 10%. Let's analyze the profit impact. First, by dropping the channel, we avoid the retail store's segment loss, which increases the company's profit by $3,000. Second, we need to calculate the increase in the online sales contribution margin. The current contribution margin for online sales is $63,000. A 10% increase would add another $6,300 to that contribution margin. So, what's the net impact on operating income? We add the $3,000 from the avoided loss and the $6,300 from the new margin for a total increase of $9,300. Based on this analysis, the decision should be to drop the retail channel. Another powerful application of this is performing break-even analysis at both the company and segment levels. For the company-wide break-even, the formula is the sum of traceable and common fixed expenses divided by the overall contribution margin ratio. For Profit Max, this comes out to a break-even point of $475,000 in sales. For segment break-even, the formula is different. We take only the segment's traceable fixed expenses and divide by the segment's contribution margin ratio. For Profit Max's business products division, the break-even sales point is $180,000. Now, you might have noticed something interesting. The business products break-even is $180,000, and the consumer products break-even is $135,000. If you add those together, the sum of the segment break-even points is only $315,000. This is significantly less than the company-wide break-even of $475,000. Why is there a difference? The reason is that the segment break-even calculations correctly do not include the company's common fixed expenses of $85,500. This leads to a critical rule to avoid a major mistake. You should never allocate common fixed costs to segments when making decisions. Doing so will artificially inflate a segment's costs and its break-even point. This can mislead managers into dropping a segment that is actually profitable and contributing to covering those essential common costs. To ensure your analysis is always valuable, be aware of these common pitfalls in segment reporting. First is the omission of costs. This happens when companies forget to assign relevant non-manufacturing costs, like marketing or customer service, to the segments they support. Second is the failure to trace costs directly. This occurs when a traceable cost, like a specific office's rent, is lumped into a general company-wide pool instead of being charged directly to that office segment. And third is using an inappropriate allocation base. A common mistake is allocating administrative expenses based on sales revenue. However, a 10% increase in sales rarely causes a 10% increase in administrative costs, which leads to a distorted and inaccurate view of segment profitability. Let's summarize our key takeaways from this session. First, go beyond the grand total. Segmented reporting provides the detailed insight needed for effective management. Second, the distinction between traceable and common costs is the absolute key to getting this right. Traceable costs belong to the segment, while common costs do not. Third, the segment margin is your guide. It's the best measure of a segment's long-run financial viability. And finally, remember the golden rule. Never allocate common costs to segments when making decisions. Allocating these costs distorts reality and can lead to poor strategic choices, like eliminating a profitable part of your business.